Welcome, students. So, we are continuing our discussion with the financial estimates and projections. And now we will learn about the next component in the financial estimates and projections is something relating to the project financing decisions. So, in the previous class, I talked to you about the two kind of decisions. One is the investment decision, and second is the financing decision. So, as we discussed already, that investment decision is something that when we decide in principle that yes, we are going to make this investment, this venture is acceptable to us, and we are going to make investment in this venture, and this venture is very useful venture, and idea we liked, and we are going to give shape and convert that into a business. So that's called as a business decision. And financing decision is something like that. Yes, now once we have decided to build a project, we have decided to give shape to that venture. So we require the funds now, right? And we have already estimated under the financial projections, we have already estimated that how much funds are required for the cost of the project, maybe for acquiring the long-term assets and for the short-term requirements of the firm. So how much funds are required, and now the question is that where to have the funds from. So for that purpose, we will have to have very clear understanding that when you talk about the say different sources of the funds, or maybe we go for the financing decisions, so it means we have to consider it very carefully, because it's a question of long-term sustenance of the business. We want to raise the funds from such sources which are regularly available to us, continuously available to us, number one. And second thing is they are not very expensive also. They are not containing any kind of the risk also, right? So it means when you talk about the financing decision, we have important considerations to bear in mind, different key business considerations to bear in mind, so as to have the sustainable project financing and to have the funds for this venture, this project from the sustainable sources. And for that purpose, we will have to have the important considerations, which are four important considerations. First important consideration is the cost, right? Now, when you talk about the cost, so cost means cost of what? It's not a cost of the product or service coming out of that project. It's the cost of the funds. Because after liberalization of Indian economy, the finance is an important component which also has a cost. Earlier, before liberalization, we never cared upon, because we didn't have the say term structure of interest rates in India. Rather, it was the reverse of the term structure of interest rates in India. So financial cost was not considered as a very important component of the total cost of the product. So under the term structure of interest rates, now for example, if we are going to borrow the funds from any source and we are going to borrow it for the longer duration, so as per the duration of the borrowing of the funds from that source, you have to pay the cost, you have to pay the interest, right? If it is equity, for example, so there is no problem at all. Equity is less risky, but equity shareholders are also expecting some good return, and if you are not going to give them good return, maybe it's a private equity. So if you're not going to give them good returns, so that would not be a good thing for maybe the business and for their equity shareholders. And we are going to raise the funds in the form of borrowings from the say some institutional sources in the form of the debt. So if it is going to be a long-term borrowing and means quite say large in amount, so we have to pay the high amount of the cost in the form of interest for that debt or for that borrowing. So we have to be very careful that where to get the funds from, where the cost of funds is also manageable and the funds are available on the long-term basis, on the sustainable basis, right? So it's a very important consideration. So when you talk about the cost of the funds, people say that we should raise the funds from borrowings or from the debt as an important component of the total capital structure of the firm. You have to form something which is called as capital structure, right? You have to form this, and this is called as the capital structure of the firm. So for forming the capital structure of the firm, you have to raise the funds, and largely this capital structure talks about is something funds coming from debt and equity. Funds coming from debt and equity. So these are the two sources. Debt is basically the external source of the finance. We call it as the external source, and equity is basically the internal source of the finance, right? So this is the internal source of finance. Now the question, million-dollar question is that what is the stage of your venture? Is it a startup or it is a project going to be set up by some existing firm who has its prior existence in the market, and for them credibility is not an issue. So if it is a startup, in that case we have very less options as far as the financing decisions are concerned. As I told you in the previous lecture, you don't have any access to the stock market, you don't have any access even to the organized sources of the funding. kind of a debt from the financial institutions or maybe the government sources or any other. You have to raise the funds from, number one, from your pocket, which you call it as, to some extent you call it as the equity, and you have to bring the funds as an entrepreneur or group of entrepreneurs from your pocket, and that is maybe the internal source of the funds. So, how much you can bring from your pocket, from your sources, from your internal sources, your pockets, that is the first important thing. After that, for the remaining requirements, as we saw in the previous class, the ratio of 70-30 was there. So 30% you are ready to bring from your pocket and 70% you want to raise from the external sources, and it is a startup. So for the startup, only ultimately the source is the venture capitalist, angel investor, or in the form of a private equity, because no financial institution is going to lend you the funds. You cannot go to the stock market, you cannot even raise the funds from any organized sources of the market. So for that purpose, you have to go to those risk finance sources. Risk means the venture sources, venture finance sources, and they are basically angel investors, they are venture capitalists or private equity providers. So they provide the funds for good ideas, good ventures, but their requirement of the return is somewhat very high. Many a times they interfere in the business management also, operations of the business also, because they want to make sure the security of their funds. So that there are some limitations, but if you want to be successful in the venture, you have to pass through all those hurdles, all those limitations, and you have to finally cross those hurdles, and you have to raise the funds from those sources. So if you want to give shape to the venture, you have to accept all those odds. But if it is an existing firm who want to raise the funds for their expansion, diversification and growth projects, so for them the cost, the funds from the other sources are available, from the established sources are available. They can raise the funds and the debt also, they can borrow from the market, they can divert sufficient funds from their existing reserves, from the retained earnings or from the internal sources of the existing firm. And if they are going to register this new project as a maybe a public limited company initially, so they can raise the funds from the market also, because they have the credibility in the market and they have some standing in the market. So two different kind of the situations we are talking about. One is a startup and one is a firm or a project is going to be brought up by some existing firm, medium or the large scale firm. So in that case, if it is a startup, so all these things are, means all the established resources are not available for us, but yes, all these considerations are equally important for us. You talk about the cost. Yes, it's important for the existing firms also, and it's important for the startups also. Risk, yes, it's important for the, even for the startups, the risk is more important, and even for the existing firms or projects also, the risk is equally important consideration which has to be borne in mind. Control is a very important issue, that whose hands the control would be of that venture. And the flexibility, that is the flexibility of maybe replacing the, maybe the one source of the funds with the other source of the funds, that flexibility is also very, very important for us. So when you want to raise the funds, the cost is important for all the entrepreneurs, all the maybe promoters, whether they are the promoters having existing business or they are new into this process. The cost is very important for both. So normally we have the funds coming from internal and external sources. So in this case, in case of a startup, for example, you want to raise the funds from the equity, so that 30 lakhs which you are bringing into the business, right, that amount of the funds which you are bringing into the business, you can say that initially you will not have any return on your investment. You are ready to forego that. Okay, we are not expecting any return the initial years, first 1, 2 or 3 years, and that 30 lakh, only our requirement is that our 30 lakh should be safe. And if it is possible, it must be growing, maybe not at a very spectacular rate, but at the marginal rate, these 30 lakhs must be growing. So that is our initial requirement. And even the venture capitalist also doesn't expect any returns if the venture is not making profits. Initially, they also understand that there would be losses in the initial years. So they are also not expecting any kind of the returns. But yes, when it comes into the profit or it crosses the break-even point, then their return or their charge on the debt would be high. And they can expect some good amount of the dividend on account of the remaining profits after paying the debt cost to them. And sometimes even they have that kind of understanding with the entrepreneurs, with the project promoters, that well, maybe in the initial years as well, you have to service the debt. Whatever the revenue is coming from the operations of the firm, you have to pay this much of the interest to us. Even that during the years of losses, and for the return of the principal amount, we can wait when the firm start earning the profits or maybe have the sufficient cash flows. So you have to service that debt also. So in this case, the point of caution is that if it is a startup and you raise more funds in the form of debt, so it means you have raised the fixed charge on yourself. Every time you have to pay, whether there is a profit or there is a loss, you have to service that debt. And in the debit side of the income statement, you have to show that interest cost, which you have to pay every year, and that is a fixed cost. So you are raising the funds. So we understand cost of debt is lesser than equity. That is no problem. That's a well understood fact that debt is cheaper than equity, but debt brings large amount of the risk in the firm. Large amount of the risk means it becomes a kind of a fixed liability on the firm. Whether you have the profit or the loss, you have to pay that debt charge. And it's a fixed liability kind of. You have raised a fixed charge on your head that you have to pay the interest on the loan, you have to pay the interest on the debt in any case. And if you do not pay the interest on the debt, so the lenders do not wait for the longer durations. In the existing firms, it's very risky situation because lenders can take the firm to the court of law and they can request the court that this firm cannot be allowed to continue because they don't have the sufficient cash flows, they are incurring losses and they are not able to service our debt on time. So they should be allowed to be, or we should be asked to be liquidated, and after selling of their all assets in the market, our funds should be returned back to us. But if it's a startup, and the fund providers also know that it's going to be a difficulty in the beginning. That's why they contribute in the management affairs of the firm. They participate in the overall management of the business or overall management of the firm, and they contribute in many ways so that any new venture becomes self-sustaining. It starts earning profits, it crosses the break-even point and it starts earning the profit, and if it starts earning the profit, certainly their funds would be safe, and even in the form of equity, the funds will be coming back to them. So they will be able to take a very healthy exit route in that case, and after earning a good return on their investment in that startup, good exit would be possible. So both ways, we have to be very careful that as far as the cost is concerned, we have to go for the cost. For the sake of the cost, we should not enter into any kind of the proposition which is a very risky proposition. And for the sake of lowering the cost of financing, if you raise the large amount of the funds, maybe in the startup or existing firms, it's going to create a problem because debt, though it's a lesser in the cost, but it brings a large amount of the distress in the firm. You are raising the fixed liability on your head and there may be a profit or loss, but you have to pay the debt cost and it would be a very, very risky situation. So this is a very, very point of caution. Whereas in case of equity, that kind of the risk is not there. Cost is higher because if you are earning profits tomorrow, so they would expect a high amount of dividend, right? But in case of loss or in case of the lower profit, you are not bound to pay any dividend to the equity shareholders or the higher dividend to the equity shareholders, especially in the existing firms. And in case of the startups, the investors can wait for the right or the appropriate time. So in case of debt, there is a low cost but high risk. In case of equity, there is a high cost but low risk. So we have to have a proper capital structure in both sort of the organizations, whether it's a startup or it's the existing firm. We'll have to have a balanced capital structure. So we have to choose the financing or the sources of financing. We have to take the financing decision in such a way that they are going to be not a risky proposition for the firm and rather a supportive proposition. So this is one important thing. And then we talk about the control. So if you raise more funds, for example, if it is the project by an existing firm, and if a larger amount of the funds are coming from the promoting firm, so it means the control of that new project, new venture would also be in the hands of the supporting firm or the promoting firm there. And minimum you have to have the 51% or more than 50%. So if it is 51% in any case, so it means the controlling stake is with the entrepreneurs, with the promoters. So it means the overall ownership of the business is safe, right? But if it is less than 50% or maybe in any case 51%, so it means the control will go in the hands of the people who have the say the contribution or who have the shareholding maybe more than 50% or maybe having the majority shareholding. We call it as the majority shareholding. So control is an important consideration. In the startup kind of a thing, for example, if the funds are coming in the form of a debt, so this is going to be a risky proposition because we are going to raise the fixed liability on our head. but the control of the venture is in the hands of the entrepreneurs. So that's an important consideration. But if you are going to make them partner in progress, if those investors are going to be partners in the progress, so what is going to happen? It's not a debt, it's a equity. And if a larger part of the equity goes in their hands, and tomorrow the business becomes a successful, or maybe a, you call it as a useful venture, so the controlling stake will go in the hands of the investors. So we should be very careful about that, in whose hands the control has to be there. And if you want to give the control to the investor, then it's your choice. But if you do not want to give, the control, so in that case we have to be very careful that where to get the funds from. So control is very, very important consideration, that whose hands the control should be. As an entrepreneur, or maybe as a owner of the startup, if you want to give the control to the investors, in that case maybe you can take the funds in the form of equity, but that's a very risky proposition. So you have to have the funds in the form of debt. There the risk is going to be in the form of servicing the debt, but the control will remain in your hands. Or if you want to give the equity, you give the minority stake to them, 10, 20, 30% of the equity you can give to the investors, and a majority stake, more than 50%, you can keep in your hands. So that can be a good financing decision. And next thing is the flexibility. So flexibility is in the form of that replacing the one source of financing with the other source of financing, or other way around, you call it as that, it can be called as keeping the borrowing capacity as reserved, or preserving your borrowing capacity. So initially, in that situation, you have to bring the funds, more funds from your internal sources in the form of equity, and you have not to borrow the funds, too much of the funds from the market, and preserve your borrowing capacity. If you do that, so it can be a very good situation that, number one, you have not raised a fixed liability on your head, so the interest obligations are not very high, right? So it means if there is a profit, fine, whatever the debt you have taken, you can easily service that. But if there is a lesser amount of profit or even loss, so because the debt component is not very high, so we are not under pressure. And tomorrow, for example, for any kind of growth and expansion of the project, if we become successful, now we have to grow, and you want to give an exit to the venture investors or to the providers of the risk finance. If you want to give them the exit, or replace their source of funding with the borrowed funds from the market, so you have the flexibility, because you have not borrowed much in the beginning. It can be for the existing firms or projects also, it can be for the startups also. And many a times, for example, if you see very good or nicely managed firms, even the bigger, medium and large scale organizations, you will find them, they always keep their borrowing capacity preserved. If you pick up the balance sheet of, for example, Grasim Industries, you will find that normally there is a standard ratio, where the standard debt equity ratio, you call it as that's a debt equity ratio. And standard debt equity ratio, when you talk about, is that standard debt equity ratio can be 2:1, right? This is 2:1 standard debt equity ratio. This says that if you invest 1 rupee from your pocket, you have the right, or you can borrow, easily you can borrow 2 rupees from the market, right? So debt equity ratio will remain 2:1, 1 rupee coming as equity and 2 rupees is coming as a borrowing from the market. And if you have that 2:1 as a debt equity ratio, it's not a bad ratio. Means people will not say that you have raised too much of the funds in the form of the debt. It's a very appropriate ratio. But if you pick up the balance sheets of the nicely managed companies, like for example, you talk about the Grasim Industries, I'm talking about the medium and large scale organizations. So you pick up the balance sheet of the Grasim Industries, Bata, Jindal Steel especially, you will find in their balance sheets that debt equity ratio is sometime it is 0.5:1, or sometime it is 0.45:1, right? It means those companies, can't they borrow funds from the market? They can easily borrow funds from the market, because if you pick up the balance sheet of the Grasim Industries, it is highly profit making company, because initially they issued the equity capital of 91 crores, right? And if you see today the size of the balance sheet of the Grasim Industries, that is for the 70,000 crores, right? So it means in the 70,000 crores of the balance sheet, only 91 crore has come from the equity capital, and their debt equity ratio is, for example, 0.45:1 or 0.47:1, right? It means where the remaining rest of the funds have come from. They have only given 91 crores. Initially 91 crores is the equity capital. Debt component is also very less, even less than 0.5%, right? Or times, you can say. So it's not even two, what to talk of 2 is to 1. It is 0.47. If you go for debt equity ratio of the Grasim Industries, you will find it is less than 0.5. Right. So in that case, how this balance sheet of 70,000 crores has been built up, it means the debt component is less than 50%. It's not two times, rather it is less than 50%. It means remaining funds have come from the retained earnings, right? Retained earnings, we call it as retained earnings, REs, and retained earnings, that part of the profit which is reinvested back into the business, that part of the profit which is reinvested back into the business. So initially the startups also should follow a policy that they should borrow less funds from the market, try to generate sufficient revenue and keep the costs under control and try to make the venture profitable as early as possible. And once it becomes profitable, they should not grab any amount of the profit in the form of the dividend. If they want to take it as a dividend, it should be a very nominal amount. And after paying to the venture fund supplier or fund provider, whatever the funds are left back, they should be reinvested back into the business. That will give the strength to the business, financial strength to the business. You will easily be able to give the exit to the venture, say a capitalist at a very early stage, and replace those very expensive funds coming from the venture capitalist with the lesser expensive funds coming from maybe from the institutional financing or maybe in the form of the other sources of the funds, where you can keep the cost under control, you can be more flexible, you can manage the risk also, and tomorrow maybe very quickly you can go up to a stage where a private company can be converted into a public limited company and you can raise the funds from the market by way of the share capital. So that has to be the financial strategy, that you do not grab the profits initially as an honor. The amount of dividend to be shared by the owners should be very less, means part of the profit you are pocketing, there should be very less. Larger part of the profit share should be reinvested back into the business so that you can grow at a faster pace. You can give the exit route to the venture capitalist at the earliest and you become self-sustaining, and very expensive sources of the funds can be replaced with the funds coming from the organized sector, from the financial institutions and maybe from the other people who are ready to invest in the form of private equity in the venture. That would be the very good financial strategy. These companies which have grown up from the 91 crores, for example, Grasim, from the 91 crores of the share capital, it has now become 70,000 crore company. The balance sheet size of the company is 70,000 crores. It means how they have grown up is they have not borrowed much of the funds from the market. Debt equity ratio is 0.47 is to 1. It means half of the amount of the total. Even the debt equity ratio is not 1 is to 1. It means how much they have invested from their own pocket and reinvested the profit. They have not borrowed from the market even that much. They have borrowed even lesser than that and preserved the borrowing capacity. So always keep your borrowing capacity preserved so that for at any maybe unforeseen situation or any expansion, diversification and growth, if you want to have the funds, you can borrow the funds from the market. For the companies, for example, these companies like Jindal's, Grasims, Bata, if today they go to the financial institutions with this kind of the balance sheet, where their debt equity ratio is less than or maybe close to 0.5 is to 1, it means they would be a very welcome organization for any bank or any financial institution, because they have proven their might, financial might and the financial discipline. And if any firm is financially disciplined, maybe it's a startup or it's an existing firm, medium or large scale, so it is going to establish in the market, itself in the market, going to grow at a very faster pace and going to get the big support from all the corners. So financing decisions has to be something which is maybe persistent or sustainable. Second thing, cost is also manageable. So go for more equity funds from internal sources, less from the borrowed funds. Risk will also be managed. If you are bringing more funds from the internal sources and borrowing less and less, so risk also you are managing because you are not raising any fixed liability on your head. Control is also largely in your hands because more equity has been issued to the owners. So owners are having the larger share of the business and they are maintaining the flexibility also because they have not borrowed from the market too much. They have preserved their borrowing capacity. So tomorrow for any expansion, diversification and growth, if they require the funds by borrowing from the banks or financial institutions, they would be a welcome organization and they would be not having any kind of the difficulty for raising the funds. So this is all about financing decisions, which is a very, very important consideration for building up of the new projects. Now we talk about the next important thing, because the end result of this discussion would be learning about preparing the projected financial statements, and projected financial statements are three. One is the projected income statement or profitability statement, second is the projected cash flow statement, and third one is the projected balance sheet. So now we are going to talk about these statements one by one. So first is the estimation of sales and production, and in a way we are going to talk about the profitability projections. So when you talk about the profitability projections, it means we have to estimate now for sales and production, that how much production we are going to do, how much sales we are going to do. So this estimate is already with us. When we have done the market and demand analysis, we have got the estimates about the sales, we have got the estimates about the production also, because how much you are going to sell, accordingly you will be producing. So partly the market and demand analysis and partly the technical analysis is going to help us to understand that how much is going to be the production cost or the production volume, and how much we are going to sell in the market, and accordingly our profitability projections will be there. So when we say, we talk about when we go for the estimation of the sales, right, we again go back to the market and demand analysis, and there we will find that as per the market estimates or demand estimates for our product or service in the market, we can easily understand that in the initial years the capacity utilization will not be more than 40 to 50%. Slowly it will increase to 50 to 80%, and maximum capacity utilization you can see of the plant which we have set up or we have built up is maximum, you can call it as 80 to 90%. Maybe third year onwards or something like that. So any company who is able to use their plant capacity up to 90%, it's a very good performance. It means whatever the plant size they have chosen, they are able to use the plant capacity up to 90%. It means sufficient demand is there in the market for their products, right? So it means 90% of capacity utilization means a very good performance, and certainly the firm is going to be a profitable venture, very good profitable venture. So we have to estimate the capacity utilization for building up our projected income statement or profit and loss account. There would be a time, over a period of time, maybe first, second or third year, when your production and sales will be equal, and that situation will be called as the break-even point, right? This is BEP. We call it as break-even point or BEP, where production and sales would be equal, or cost of production would be equal to the value of sales. So that would be the break-even point, and we will talk about that for acquiring or getting the desired amount of the sales. The selling price which we are going to talk about is that must be the realizable selling price. We should not be daydreaming that we can sell the product at any price or something like that. This is a point of caution and secret of success also, that if you want to succeed in the market, keep the price as low as possible. The realizable price means as low as possible, and for our purpose, for our analysis purpose, we decide the price. That price is basically net of the excise duty, because excise duty is going to go to the government. That's not going to stay with us, that's going to the government. So how much is going to stay out of the total selling price? How much is going to stay with us? From that we have to subtract the cost, and then finally we will have to work out the profit or loss situation. And the selling price used may be the present selling price. So it means at what price we are going to produce today and you are going to sell in the market, that is going to be our important consideration. So that we are going to do here. So it means in this case, when we are going to talk about the profitability projections, first of all, we have to be very careful about the capacity utilization over a period of time. First year 40 to 50%, second year 50 to 80%, third year and onwards 80 to 90%, and we would assume that yes, we will reach the 90% capacity utilization of the plant at the end of the third year or by third year, and from third year onwards our 90% of the plant capacity would be usable. And we would try to reach at a situation where the production and sales become equal, maybe cost of the production and sales value become equal. So we reach at the break-even point at the earliest. And the price, we have to be very careful. It should be the minimum possible price, a realizable price, and the present price. So that whatever that analysis you are doing, your cost is also based upon the present cost of inputs. Your price is also based upon the present price and realizable price. So the comparison between the two would be possible. And finally, we will see that what is the sales value, what is the total cost, what is the difference, right? And we have to create a situation as soon as possible where your sales are more than the cost of production and we are at the state of the profit. So this is going to be the entire process of estimation of the sales and production. And if you look at this sheet, so estimation of the production and sales is going to be something like this. We can manufacture only one product, or we can manufacture the multiple products. So if we are going to manufacture the multiple products, it has to be something like this. And if it is only one, so we will be limiting up here only, and this is going to be our detail for this. So it means this sheet is going to help us to explain at any level to anyone, that is what is our installed capacity, quintals per day per annum, and then it is the number of working days, how many days the plant would be working, number of shifts in a day, estimated production per day in, say, the quantity is going to be how much, estimated annual production is going to be how much, estimated output as a percentage of the plant capacity is going to be how much, then sales quantity after adjusting the stocks, means how much is available for the sales and how much we are going to keep as a stock, closing stock, and what is going to be the value of sales for different products, 1, 2 and 3 products. So this all details we are going to work out in the form of a sheet, so that if all these quantity estimates are available with us, then we can convert those quantity estimates into the cost, and then finally on the basis of the expected or realizable sales price, we can calculate the sales value, and finally we can compare the sales with the cost and cost with the sales, and vice versa. And finally we can work out the state of the profit and loss. So this is just beginning of the discussion about the profitability projections, or you call it as the estimation of the sales and productions. We will have some more discussion that how to calculate the cost of production, how to talk about the, say, working out on realizing the selling price. So all the detailed discussion to work out the cost of production, how we calculate the total cost of production, how we work out the selling price per unit and total sales value for the total volume which we are going to have. So, and finally how we are going to present in the it in the profit and loss account, and finally how that profit worked out is going to contribute in the cash flow and balance sheet. All these discussion we will be continuing in the subsequent classes. So at the moment, after initiating the discussion on the profitability projections, we will stop here, and the remaining discussion about the profitability projections and estimation of sales and production we will have in the next class. Till then, thank you very much.